Okay, let's unpack this. Have you ever wondered why, despite all the really smart people looking at it, our financial system just seems to keep, well, surprising us?
Yeah, doesn't it?
We're doing a deep dive today into some of the hidden gears of the global economy and exploring why macroeconomics often seems to miss the mark.
It's pretty startling, actually.
It really is. I mean, you hear senior economists admit quite openly that macroeconomics hasn't fundamentally progressed in maybe a century. They're constantly blindsided. Think about the huge inflation spike in 2021, 2022, or these banking crises that keep popping up.
And what's truly fascinating here, and maybe a bit worrying, is why. Their basic models, the foundations they work from, often just completely ignore what banks actually do.
Ignore the banks. How?
Well, many economists, being honest, couldn't really even comment properly on the 2008 crisis. Why? Because, as they actually admitted, their theories literally don't have any banks in them.
Wow. That seems like a pretty big gap.
It's a fundamental gap, yeah. Almost shocking when you think about it.
So, okay, our mission today is to sort of pull back the curtain. How do banks really work? Where does money actually come from? And, how can figuring this out maybe show us a clearer path to more widespread economic abundance?
Right, let's start with a big one. A really common belief you might have. Most people, actually, there was a survey in Frankfurt, something like 84% of people there thought governments or central banks create most of our money.
That's the standard assumption.
But it's largely wrong. If you look at the actual numbers, central banks, they only create maybe 3 to 5% of the money supply. Tiny, really.
Exactly. So if it's not them,
who is it?
The crucial secret, the thing that changes the whole picture, is that commercial banks, your high street bank, basically create the vast majority of money.
How do we know that for sure?
Well, my own research involved the first proper empirical test of this in banking history. We actually measured it, and it showed conclusively that the textbook story, banks are just intermediaries taking deposits, lending them out, it's just wrong. Okay, here's where it gets really interesting then. If they aren't just lending out money someone else deposited, how on earth do they create it? It sounds a bit like magic.
It does sound like it, but it's very, very real and legal. Banks create money not by getting deposits first, but by extending credit, by giving you a loan.
So the loan comes first.
Yes. And in making that loan, they simultaneously create a deposit in your account. See, legally, a bank deposit isn't your money sitting in a vault. It's simply a record of how much the bank owes you. It's an IOU from the bank.
Okay.
So when they approve your mortgage, they're not finding someone else's savings to give you. They create a loan contract, and by virtue of that contract, they create a new liability on their books that deposit in your name. Poof. New money.
Oh, okay. They effectively invent new money just by issuing a loan.
That's essentially it.
That ability for just regular commercial banks to literally invent money, that must give them immense power, right?
Yeah.
And the type of banking system we have must really shape things.
Precisely. It has huge consequences. We see a really stark contrast if we look at two basic models. On one hand, you have highly centralized systems. Think the UK, where maybe 5 massive banks dominate everything.
Right.
What do? They tend to lend billions, mostly to other large financial players, hedge funds, private equity firms. And what's that money used for? Often just buying existing assets, real estate, stocks, financial derivatives.
So not necessarily building new factories or anything?
Less often, yeah. The result is that this new money mainly pushes up the prices of those assets. You get asset price inflation and these notorious damaging boom-bust cycles that we keep experiencing.
Okay, so it's one model. What's the alternative?
The alternative is more decentralized systems.
Yeah.
Think about many East Asian economies, Japan, Korea, Taiwan, Singapore, and very notably China. There you often find thousands of smaller local banks.
Thousands, okay.
And these banks, they primarily lend to small local businesses. For what? For productive business investment, building things, buying equipment, hiring people.
And the results. So what does this all mean for people living there?
The results are pretty astonishing, actually. You see high, steady, sustainable economic growth, sometimes hitting 15% a year for decades in some cases.
50%, wow.
Yeah. And it leads to widespread abundance, a much fairer distribution of money, and you don't tend to get those wild asset price bubbles nearly as much. I mean, Look at China's transformation in just one generation. It's a powerful example of this approach.
That's incredible.
And this understanding, it helps us rethink other big ideas too, like the whole limits to growth argument, the idea that we have to stop economic growth to save the planet.
Right, you hear that a lot.
But it's arguably not true in the way it's presented. Economic growth, the way we measure it now, is often a bit of a statistical fiction anyway. Our GDP numbers, they don't always distinguish between genuinely useful production and, say, pollution cleanup or financial churning. Environmental protection comes from doing the right things, specific actions, not just stopping everything labeled growth.
That's a really important distinction. It reframes the problem. Okay, speaking of policies and real-world effects, this idea of banks creating money, does it help us understand things like quantitative easing, QE?
Absolutely. It's key. Think about QE1 back in 2008 in the U.S. That was mainly about cleaning up toxic assets on bank balance sheets. It arguably helped stabilize things and led to a recovery eventually.
Okay, but then we had QE2 in 2020.
Right. And QE2 was, you could argue, applied at exactly the wrong time, using the wrong mechanism for the problem at hand. You pumped massive amounts of new liquidity into the system when global supply chains were completely snarled up because of the pandemic.
So too much money chasing too few goods.
Precisely. More newly created money chasing restricted supply. It was almost bound to contribute significantly to the inflation we all felt.
Okay, so looking forward then, what should we be thinking about? Are there risks on the horizon related to this?
I think a really critical point to watch is the push towards central bank digital currencies, CBDCs.
Like digital dollars or euros controlled by the central bank.
Yeah, exactly. Now, proponents talk about efficiency, but the potential downside is a massive centralization of power. It could give governments unprecedented visibility and potentially control over every single transaction you make. Maybe even switch off access to your funds.
That sounds worrying.
It could be. And counterintuitively, that level of central control might actually lead to less dynamic growth, less prosperity for ordinary people. The real engine for widespread prosperity, the evidence suggests, is a decentralized financial system. Lots of small local banks lending for productive purposes in their communities.
Like supporting local businesses, creating local jobs.
Exactly, revitalizing regions outside the main capital cities. We've seen discussions about this potential in places like, say, the Hungarian countryside, needing that kind of local investment.
So the really profound insight here for you listening is that the actual plumbing, the structure of our banking system, isn't just some technical detail. It directly shapes our economic reality from big things like growth and inflation down to, well, jobs and opportunities right there in your local town.
Which really brings up an important question, doesn't it? Something for you to think about. Given that commercial banks literally invent the money they lend, how can we all advocate for a financial system that genuinely serves our communities? One that promotes sustainable, widespread prosperity for everyone, instead of just, inflating asset bubbles that benefit a few.